All right. Good morning, all, and thank you for joining us today for our expert speaker series on biofuels. Today, we are going to take a closer look at the RFS, LCFS, and carbon credit markets, and the outlook for biofuel projects more broadly. I am Derek Whitfield, Stifel's Biofuels and Upstream Analyst. EcoEngineers is a renewable energy consulting firm specializing in clean energy consulting, and regulatory compliance services. The organization was founded in 2009 to facilitate compliance for the use of renewable energy by providing access to in-depth knowledge of the regulatory, scientific, and economic drivers that affect the industry. EcoEngineers is a global leader in this sector and provides consulting services to the majority of our coverage. With that said, we are pleased to have Brad Pleima, the President and Senior Engineer of EcoEngineers, and Paul Niznik, a Senior Carbon Consultant, in attendance today. Mr. Pleima is a licensed professional engineer and accredited LCFS lead verifier with over 15 years of experience in the sector. Mr. Niznik has 3 decades of experience in the sector, and his due diligence on the carbon markets has been used in the financing of some of the most capital-intensive biofuel projects in the nation. I've asked Brad and Paul to provide a 15 to 20-minute intro on their organization and the sector, referencing the slides included with this webinar. Following the intro, we have prepared a list of questions focused on the most pressing credit market topics impacting the biofuel sector today. We would encourage your participation throughout the Q&A session, and we'll make every effort to answer all questions submitted. Please feel free to post them through the webinar or send them directly to me at whitfield@stifel.com. With that, I'll turn it over to Brad. The floor is yours, Brad.
All right, thanks, Derek. Really appreciate the opportunity for Paul and I to be here. Just a little bit more about EcoEngineers, and like Derek said, we're a renewable energy consulting and auditing company. We really do, we're broken down into 6 service areas on the left. We do a lot of training and education, regulatory engagement, life cycle analysis. We do a lot of carbon intensity modeling. We've done that for coming up on 400 different facilities. We've submitted several hundred LCFS pathway applications. And as Derek said, we're an accredited verification body under the LCFS program. I imagine that will get some attention today with where LCFS credit prices are currently at. We also have an asset development consulting group, and we help people set up compliance systems. So all the carbon credits, RINs, LCFS credits, we have the expertise and the experience helping people register the projects into the various programs, do the ongoing compliance. And then we're auditors under the Renewable Fuel Standard, one of 2 companies that are approved to do that under the RFS, and one an accredited verification body under both the Oregon Clean Fuels and the California Low Carbon Fuel Standard. We're working with about 150, 160 operating renewable fuels, biofuels facilities under those various audit programs. And you can see here on the right, we do this in all different low carbon fuels. RNG, which is my background, do a lot of ethanol, biodiesel, renewable diesel, getting more into renewable electricity, renewable hydrogen, and getting into voluntary markets, which I think Paul's going to touch on a little bit later too. Really, we're technology agnostic and we're fuel type agnostic. Because of our audit, we're a little bit unique in this industry where we're truly third-party consultants. We can't have any equity or any ownership. We'll never take title to any of these credits. Truly play that third-party consultant and auditor role across the wide spectrum of biofuels and lower carbon energy. So that's just a little bit more about EcoEngineers and who we are. And this is timely discussion. We recently finished a Renewable Fuel Standard and LCFS fuel supply analysis and pricing reports for both of the various programs. And I think Paul and myself, we've kind of been looking at the LCFS supply demand, which Paul will touch on. And we saw this coming, this credit decline coming about 18 months ago with the amount of renewable fuels that were coming into the market. Maybe it's been accelerated a little bit quicker than what we expected, but we're going to talk a little bit more today about what that outlook looks like, both on the LCFS side and the RFS side. So what we're doing is analyze 10 years of historical data in both of these, and then projected out where will fuel supply and where will the deficit supply come from, and what does that look like over the next three years, and then how will that impact pricing to 2025, and then from an LCFS perspective, we looked at pricing to 2030, and trying to put all these puzzle pieces together with the renewable fuel supply, and also on the deficit and demand side. We're making these living documents. We're doing a quarterly update of both to see, are the projections, after the last quarter of data, are the projections on schedule? Did we learn anything new over the last quarter that would change any outlook of where things are going? So with that, I'm going to turn it over to Paul, and he's going to walk through a little bit more of the details. Paul?
Thanks, Brad. I'm Paul Niznik. I'm the RINs guy, so naturally I'm going to start off with RINs. And Derek teed up that a majority of our audience today is working on advanced biofuel projects like RNG, next generation. And so we're going to focus right now on a quick review of where the D3 RINs are. That's the cellulosic type RINs, but the more advanced type RINs that come with RNG projects, advanced biofuels, maybe if we're looking at electricity from biogas, which is on the horizon, those kind of projects that people are seeing that are relevant to the RFS. Quick review, because we always want to get people on the same page here. The RFS is the national program. It's a volumetric program designed to put renewable fuels in place of fossil-based fuels. This is a very popular program across the ag sector because the majority of fuels are coming out of traditional commodity crops like corn or soybean oil. The original goals were to reduce U.S. dependence on foreign oil sources. That's an interesting question right now as we start talking about building advanced biofuel plants that particularly renewable diesel that run on vegetable oils that are going to start coming from other sources around the world. But then also when we think about the current geopolitical situation, we're talking about agricultural crops that are under stress from current events in Ukraine and other future worries. Right now, there's recent news on a palm oil export ban. So this is very relevant to understanding all the impacts in prices on the RINs that end up coming out of the biofuels in this program. And moving forward, one of the biggest sectors that this program was supposed to incentivize was the lowest greenhouse gas emitting fuels. So there's a heavy emphasis on these low carbon intensity fuels, renewable natural gas being one of them, but also renewable diesel, biodiesel, things that are specifically lower in carbon intensity. And the biggest event that is going to occur is something that was built into the program from the beginning of the RFS2, which is a schedule reset. This is pending on the horizon, so it's the big event that people have been considering for a long time. What will happen? The most important thing is to understand that the program doesn't end. Just like the implementation of many other fuels programs in the United States, when Congress passes it, sets a schedule for lowering emissions or lowering or the speed limit. When these things go in place, they don't end until Congress makes another act. There is a chance right now, and this is what's getting the market a little interested. What is the shape of the rules past 2022? Certainly the schedule has to be discussed, but there's a lot of optionality for changes to the rules. RINs prices have been doing very well, but they've been impacted in the past by some of the problems that plague many programs, which is politics. So when we look across here, and particularly the green line in your screen is the D3 average RINs price, we can see it having gone through a very tumultuous phase over the last couple of years. This range that you see in light blue is the range in which the D3 RIN can play. The D3 RIN basement price, as evidenced by what happened in early September, August of 2019, that is D5 RIN price. That price represents the replacement cost or value of that RIN when no one needs any D3 RINs. There is a structural the rules are structured in a way that allow RINs to replace lower category RIN. So even when you're oversupplied with the RIN, it doesn't drop to zero. It just drops to the value of the category below it, because people can use it to replace it down there. On the top, and this is important to talk about, that purple line at the top of the range represents that D5 RIN price plus the annually issued cellulosic waiver credit price. So that's what we consider the cap price. The cellulosic waiver credit has been around every year that that this program has been there, but it is a optional thing to come into play. So people are concerned about, hey, will this range exist with the new rules? The cellulosic waiver credit is issued every year. It's set at a certain price, though they haven't done it. We know what it is each year, even when there's a delay in the rules. And that is the upper replacement cost for these RINs. So the RINs travel within this range of the two replacement values that they can be. When it's a healthy market, as you've seen in the more normal years, when they set the rules every year, they generally try and balance the amount of demand for this product with the amount of expected supply. This is an annual exercise. So in general, they usually keep the market tension fairly tight, and people are usually, as you see before 2019, trading near the top of the range, always with an eye on where that top price, replacement price could be. And then we can have disruptions. This is a favorite slide of Brad's, talking about the different disruptions that have occurred in the past. And for investors, it's something to think about. You do want to know what things can step in and disrupt prices. This is about a supply and demand market where people are looking at the outlook. They already know what the balance is going to be. So if there's any disruptors that come into play, they've got to talk about the future value of the RIN within a range and the future supply and demand. In some years, we had generation outpacing the RVO. We had an administration in place that would ostensibly be non-favorable to putting out strong RVOs. But then most importantly, we had small refinery exemptions that's shown there as SREs. These are exemptions that are kind of retroactive. So it's people who have already used their RINs getting exempted from their compliance from previous years, who then go get their RINs back and dump them into the marketplace, much like having your tax audit paying your taxes for previous years, then the government going and say, hey, you didn't know taxes those years, they give you back your money. Same thing happens here, and into a very delicately balanced market, a market that was planned to have a very tight range of supply and demand, to dump RINs in the market as much as 10% can really be impactful, as you saw it happen down there. Then, of course, other political and rulemaking events can happen. Of course, COVID had an impact on everything, but more importantly, political change that occurred over the year, changes in the rules to try and balance out the SRAs. And most importantly, right now, what we've seen is that one impactful event, the SRAs, is now getting washed out of the system. According to the rulings we're seeing from the EPA, they're saying, hey, we're going to get rid of SREs. In fact, just this month, they denied 36 SREs that was tied up in a court battle. Here you see just the most recent 2 years of D3 RINs as a percentage of their potential range. So really what you can see here is market sentiment, which has been generally being very positive. They're moving up to the top of the range, and the prices feeling like things are both politically and ruling wise much more like the rules that we had seen in the past, pre-2019, and particularly that elimination of some previous year, the denial of some previous year applications for SREs, those 36 SRE event. You can see that happening there in mid-March, and then that recovery and improvement in the RIN price. And for investors, there's two takeaways. One is that unfortunately the RINs price is very subject to political and rule making issues. The general trend of rules generally balances the tension on the marketplace in a positive direction for prices to move them to the top of the range. But as you can see, strange little events can affect things. And the RFS is a particularly political vehicle. The RFS is supported by agriculture interests in the Midwest. Those are very political states, the Midwest, they're generally kind of purple to Republican, and yet there's a lot of support for the RFS among some of the most staunch Republican senators there. Particularly, I got to call out Chuck Grassley, who probably, even if he ever dies, from the grave will have zombie letters written to the president supporting the RFS. So those kind of powerful interests in the Midwest have always supported the RFS, always been a counteraction to any efforts to push away from keeping normal operations. But we're moving into a phase of changes. As we said before, we've got this rulemaking that needs to happen. It may not happen right away, but we need to have a set of new schedules past 2022. We're about to have a multi-year catch-up rule. The current administration really took its time after getting elected to make up for some shortfalls of the previous administration on annual rules. People are moving along with some guidance from the EPA, but we really haven't had a formal rule that might come out in June. That's what the rumor is going to come out in June, a proposal, but that would already be a year and a half, 2 years late for many of the markets. So people may have some catching up to do on some of their own reconfiguring. We're going to see further decisions on SREs. We obviously saw this first one, but that was really for 2018 applications. Obviously, they're just sorting through the paperwork over there at EPA. So we're going to hear more, but I think the writing's on the wall for SREs. If I had to go out on a limb, I'd say we've seen enough of them. If we don't, if there is SREs, it's probably going to be a few, but if they suddenly change their mind, they have actually even adapted the current set of rules. There's a second parallel set of requirements for potential rules that would accommodate SREs. So there's a very much a system in place to accommodate SREs, or if either eliminate them or account for them in the math to sort of ameliorate their effects. So in this year, we're going to see a lot of things come down the pipe. And of course, as I mentioned before, the agricultural and petroleum prices right now are, no one's surprised by the volatility we're seeing. There's going to be reactive moves out there to protect certain interests, and it is a global market. So whether it's the Ukrainian agricultural situation, or we're talking about sudden moves like Indonesia, which just tried to ban exports, to reduce exports of vegetable oils, to preserve prices within their, to lower inflation within their own country. Those kind of impacts on a global market are definitely going to come in to affect RINs prices. In the case of the D3 RINs particularly, that affects the basement price that we talked about in that range. And you saw that does move up and down, but also for advanced biofuel projects, we're talking about a lot of renewable diesel plants getting funded that use vegetable oil. We're talking about, so they're going to talk about scarcity of vegetable oil. That could definitely be impactful. And vegetable oil is a big portion of understanding vegetable oil markets. It's a big portion of the due diligence around projects we do there. We get a lot of questions about E-RINs, so I'm going to knock it out right now. Brad, you were on a recent call. I'm going to call you in here. You were on a recent call with one of the trade support groups. If you unmute there and maybe you could weigh in on E-RINs and maybe whether or not they'd have any impact at all on markets, but also the opportunities there.
Yeah, sure. I think it's been a hot topic, E-RINs, and I think for, we've been hearing people have been optimistic about activating that pathway. So there is a pathway in the existing rules for following like in D3 and D5, pathway Q and pathway T for renewable electricity used in vehicles. It's just EPA has not approved any of those. And there's many pending pathways, a couple dozen pending applications that just have sat there for many years, some of them up to 5 years. But I think for the first time with this administration's focus on renewable electricity and EVs, there's been a lot of push within the industry and politically to activate that. And we're hearing some optimism that maybe even in the next couple of months, EPA will announce some intention for rulemaking to go through the E-RIN process. They still have to do some work there. Who has the rights to generate these credits, how exactly mechanically they would get done. There needs to be some clarification from EPA on that. But I think we do expect something to happen. Will they announce something, and then what will that runway look like? some people are optimistic and think maybe January 1st, 2023, that something could, pathways could start happening, and E-RINs could be a thing. Some people have said, now maybe it won't wait until 2024. What I'm really interested in looking at is, Paul mentioned there, that multi-year rule. What does the next 2022, 2023, 2024 look like from an RVO, renewable volume obligation perspective? And if EPA releases that, and maybe even in batches, they may do a couple of years at a time, like they did in the proposed rulemaking earlier in the Biden administration, then what we'll watch for is, will there be a significant jump in that D3 RVO? So right now that's looking to be 600, 700, maybe up to 800 million gallons on the D3 side. All of a sudden, if that jumps to 1 billion or well over 1 billion, we can be fairly sure that of that billion plus, some portion of E-RINs would be there, because RNG is just not not growing at that rapid rate from a volume perspective. So really, the E-RIN needs to be thought out, and it needs to be accounted for in the annual RVO process, or that's going to negatively impact pricing if they don't. So that's the thing we'll be looking at is there rulemaking coming out here in May or June? And then when will EPA activate that? And we'll be looking at the RVOs, the proposed RVOs, to see, was there an allowance for E-RINs in those future numbers?
Reading the tea leaves.
Yep, exactly.
Yeah, and just to clarify things, the investors are worried. So there's a concept out there that these E-RINs could just show up and then flood the market, much like an SRE event, that suddenly there's applications. We know all about applications over at EcoEngineers. We also know about how EPA can throttle applications and not let them come out. And I'll just say, based on experience with the EPA, they are not going to allow E-RINs to show up in the middle of a year where they haven't planned ahead for it, like Brad's been talking about. The E-RINs themselves are not a sort of Damocles holding over the market that could suddenly burst and flood it. Instead, it's really just an upside opportunity for investors. Maybe people in the power space are looking at assets that currently are power generation from biogas, which there's zillions of those out there from the last 3 decades of work. And that's an opportunity to enter into this space. And really the question is, when can you start monetizing this? What are the rules around that? Because they're going to be very complex, probably more complex than the ones we see in the LCFS space, where there's sort of a group accounting on these kind of things. It's going to be tough. There are going to be really delicate rules to follow to monetize it. And but certainly compared to generating electricity right now, it's going to be very attractive. So people are going to want to be paying attention to that. All right, I want to keep cognizant of the time and move over to LCFS, but I'm going to move over to the current situation in the LCFS, which, as Brad alluded to, has gotten people a little hesitant. Just a quick review. The LCFS is really the shape of carbon programs to come. It's currently trying to reduce emissions in California's transportation fuels by 20%, with a schedule that uses a sort of accounting performance-based system on every single fuel used in California. So it's much more diversified in its attention to fuels and project-based biofuels or credit generations. And so not fitting things into fat categories like RINs, but more getting project specific. It's been very successful to date in stimulating investment, and it's been very successful to date in lowering the amount of carbon intensity in fuels. As you can see here, here's the schedule of requirements. The weird bumpiness back there in the early portions of the program are actually the historical reconfiguring due to some lawsuits. But from a stability perspective and from a political perspective, this program has really moved into a sort of phase of vetted. The judicial wrangling has worked its way through. Those earlier things were actually rather minor issues on rulemaking rollout. As you can imagine, California is sort of a monolithic political entity, not really seeing a lot of back and forth expected there in the future. Meanwhile, having been judicially vetted and then having a lot of political stability, this program has a lot of eyes on it, because people can say, I don't have to have some of that weirdness that I've seen in the RFS. I can sort of count on this. For those who haven't experienced it before, it's a simple accounting system. Your fuel, whether it's petroleum or biofuel or electricity or something else, gaseous, is judged. the judgment gives you at a CI score. If your CI score is above the requirement for any given year, you are generating deficits. So primarily the petroleum fuels like gasoline and diesel. But if you're lower, then you are generating credits that can be used to help balance out the higher, the deficits from the higher base fuel. Very simple system, very accurate system compared to the RFS anyways, and really the shape of systems to come in the future. With this kind of stability, people have put a lot of pressure, put a lot of work into lowering carbon intensity scores, and that has sort of resulted in the program recovering from what was a dire situation even a couple of years ago. As you can see here, 2017, it sort of reached its peak and started generating net deficits year over year. People were thinking, we used to use the term spiral of doom. How are they going to dig out of this? We can only use 10% ethanol. No one's going to want to invest in biofuels, because for those of us who've been in biofuels, no one ever wanted to invest in biofuels. How are you going to get the big volumes online in California? But, you know, it was the time, it was the push that was needed for some of the bigger players to jump into the space. And so by bigger players, I'm talking refiners. They stepped up. They've started investing in renewable diesel from vegetable oil, maybe co-opting some of their original equipment that was working at cracking barrels into diesel. Now they're cracking vegetable oils into renewable diesel. And we're seeing a really good supply. And the market is very cognizant of the announcements of projects and the data that's coming out. And we've seen the price sort of reduce over time, with people saying, you know, I think this program actually could balance under these current set of rules. I think what we have going on is, it sounds pretty tenable to achieve the goals. You know, whether that mathematically is true or not is a matter of how you schedule out the scenarios. Some of the other markets, maybe not so much, but as you can see on this screen on prices, the blue line is the big market. California LCFS credit prices dropped quite a bit over the last year, but sort of might be moving into an equilibrium range, which we expect to have happen. You can't drop it too far down, or some of the optional fuels will leave the market. Meanwhile, you can see competition on credit prices from other markets. It's not apples to apples. The Oregon CFP price and the Oregon and the pressure on that market is not the same as in California. So just because those two prices are similar, you can't say, oh, well, you know, there's going to be some back and forth between those markets. But there is cross-border consideration for the fuels that could find a home in those markets. So particularly the most miscible fuel is renewable diesel. You know, that's a spot fuel as opposed to a termed up fuel like, let's say, electricity or renewable natural gas, which is going to be on a contract for multiple years, and it's not going to be fuel that's switched out too much. Also, to our Canadian friends to the north, there's another LCFS type program up there. The British Columbia has one. And those prices, while they look extraordinary here on the graph, you have to recall that they don't have any of the supplementary economics that we have here. First of all, that's Canadian dollars. Love those folks, but their dollar isn't worth as much as ours. Secondly, they don't have an RFS program supplementing a lot of their prices. So while the D3 RIN is supplementing renewable natural gas, for instance, to the tune of 20, 30 bucks American per MMBTU, they don't have that in Canada underpinning things. They do have a shortage of the fuels they need to achieve their goal. Their goal is pretty ambitious, particularly compared to Oregon, and they're in the midst of a rulemaking right now to expand their program. Same with Oregon. So we may see some shifts there as their policy changes. Meanwhile, right now in California, we're seeing the beginnings of a discussion of what are we going to do past 2030. Are we going to expand the program? I mean, the short answer is probably yes. We look like we're achieving our current schedule according to prices, and we're more likely to have an expanded program past 2030, and that's actually important now. I know it's many years away, but these credits that you get don't expire, unlike the RFS. So some people who hoard them, and they definitely hoard them as the only insurance policy towards a short market, do think about the future value. So if the program is going to be expanded past 2030 in terms of the carbon intensity schedule, we're going to need to understand what that is and what that means to the market. And there is a chance that the schedule that we've seen before, and I'll pop that back up, there is a chance that this compliance could before 2030 could be changed. There's rumors of that. We've seen the workshops. We participate in those and monitor them closely. So this market could get tighter than is anticipated right now. I think there's probably even money that could happen. Moving forward, when we're talking about things that can impact the market in the short and the near term, we're looking at the quarterly data releases. We haven't had all the data from 2021 come out yet. That comes out the end of the month. The big question is, what's going to happen with renewable diesel? How much is going to be in the marketplace? And will it be all going to California? There's other markets for this. So we've got European markets. We've got British Columbia and Oregon. We have a program rolling out in Canada. We should be getting some proposals for that. A Canada-wide program would obviously be a huge demand factor, not immediately, but in the future. And Washington State passed a rule, and they have to implement those rules. So as those start to roll out, we'll see if some of the optional, the more spot fuels, the more miscible fuels will start being pulled into some of these other markets. Certainly, the European market is competing for those fuels and feedstocks right now. One of the things I wanted to point out to everybody is the voluntary market. As Brad mentioned, this is going to be incredibly important moving forward. This is another source of value for a lot of projects. It is a very carbon intensity focused market. So we will see these programs start to take some fuel away. We're already seeing that in the RNG space. And quite frankly, I had a slide that I didn't put it up because I didn't want to scare people, but by this time next year, I am sure that everybody who's on this call today will not be just worried about LCFS and RINs credits, but they're going to be talking about voluntary carbon credit accounting. They're going to be talking about offtakes that go into markets that are carbon sensitive, but yet not mandated markets. We call them voluntary markets right now. Eventually, people are assuming they will be mandated. Plenty of people on the call today probably heard about the SEC putting out proposed rules where publicly traded companies are going to have to start disclosing their carbon exposure, their environmental exposure as part of really relevant risks. They're finding that so many programs around the world are already in existence, and that we might be in a situation like that here in the US, so that publicly traded companies need to start talking about that. And I can tell you that we're already working with lots of companies to talk about carbon intensity. We're working with tons of companies who make projects that focus on carbon offsets to participate in those programs. So even though they're not mandated markets like the ones we've just been talking about, they do have credit prices. They do have offtakes. Some of them are not spot-based offtakes, but long-term offtakes at set credit prices, which is going to be very attractive to investors who are a little more risk averse, such as our debt investors, some of these fund investors and muni investors. These folks are going to be looking at some of these projects and saying, I want to step aside from maybe a spot market kind of exposure. Maybe I want to have more exposure to a termed carbon project that's still green, still participating on some really great upside, but is actually over here in this voluntary market. I think that's the real expanding space right now. And Brad and I are really busy working with projects across the board in that space.
Just to kind of round out on LCFS, I think RFS is, has buffered some of that those lower LCFS credit prices with $3.40, $3.45 D3 RINs. Certainly has helped. And the question we get all the time is, well, this LCFS credit pricing, right around 115, been between 110 and $125 per credit here over the last several months. And I think we're anticipating that volatility to continue and and pricing to be a little bit more depressed than it was. I mean, the chances of it going back to $200 per metric ton we see are probably pretty low, depending on if CARB doesn't do anything about changing, resetting the goals, just because there's so much fuel. Pretty much every renewable fuel project in the world is looking at California and is examining, does that market work for them? But like Paul said, at some point, at some price point, then they just, you're not going to ship renewable diesel halfway across the world at a $90, $100 per metric ton LCFS credit price. So I think we are kind of starting to find where that, maybe not the complete bottom is, but things have stabilized. And then going into the future, the back half of the decade, I think we're more optimistic that pricing can go back up because we're going to see many more of these states that have programs. Paul referenced the Canadian, the national clean fuel standard. That's about the size of the California market. So that will be a huge another place for fuels to go. But I think expecting some of this more, shorter term pricing to stay where it's at, and then maybe increase in the next few years. But we'll be watching the data to see if that is reflected to our projections.
Yeah, there's so many fuels that participate in the market. It's a very scenario-based outlook. You have over 32 different fuels and subfuels generating credits or deficits in that marketplace, and in on these other programs. Some of them aren't as optional, like electricity. That's pretty much tied. But when you talk about some of these other fuels, you've got to really have a scenario where all the fuels in the whole world start descending on California in order for us to really get the price down very low. Whereas this, every project that investors are looking at is making an offtake agreement in their business model, based on the prices at the time. So when each new project or potential source for credits comes online, they're looking at the options, at the diversification, and we're helping clients understand the broader markets, both in the United States, Canada, and around the world, to understand what's the optionality there, how to diversify risk, or how to structure offtake to avoid some potential downside. So Derek, do you have some questions for us here?
I do. Thanks both Brad and Paul. Terrific, insightful overview. And with my first question, I wanted to start at a high level with the current state of the California LCFS market. For the benefit of the group, could you provide some historical context around the cumulative credit bank, trends in average carbon intensity of RNG and R&D, and color on the amount of projects entering the market place today and their progression versus initial expectations?
Yeah, no, those are all good questions.
Those are all good questions. Yeah,
I think we just to touch maybe at a high level on each one of those. Paul, can you go back a couple of slides on the bank, the deficit and credit graph there? Yeah, right. Yeah,
this one?
That one. Yep.
Yeah.
So you can see here when credits and deficits, that's supply and demand basically in the market. And so when the deficits are higher than credits, so when that orange line or that orange bar is higher than the blue bar, that means there's not as much credits out there, and the bank decreases. You can see when credits outpace deficits, which happened from 2011 all the way to 2017, that bank is getting built up. There's way more credits out there than there are annual deficits, and people are banking those. And so the pricing is going to stay depressed. Once we started hit the peak at Q4 of 2016, that's really for the next year, the credit deficit stayed relatively in balance. And you can actually see then in 2018, we started taking credits out of the bank because there was not enough of them being generated. So what has happened though is that really kept the price at the peak, at the price cap of $200. And so what has happened is the market reacted. Everyone said, holy cow, $200 per metric ton. I can make a ton of these projects work. I'm going to go build a bunch of them. I'm going to go develop a bunch of them. And really, especially in dairy RNG, there's hundreds, 200, 300 of these projects in development still. And combine that with the 3, 4, 5 billion gallons of renewable diesel that's been announced. And that's where Paul had mentioned there's some future speculation, that's built into this. What is going to come online in the future, and then what is actually generating credits and deficits in the year over year or quarter over quarter time. And you can see the credit bank started to decrease, which means there wasn't enough credits to keep up with the overall demand. And then in 2021, the deficits for 5 out of the last 6 quarters, there's been more credits than deficits. So an oversupply of credits means we're going to start rebuilding the bank again. And we expect that to continue into the future because of all of the renewable diesel, all of the low CI RNG and all of the low CI electricity that's happening in the market. Those three are big contributors to the credit supply side. And then you had COVID happen, where the overall, consumption of fuels was down, and that's still not all the way back to where it was pre-COVID. So you have an oversupply of credits, or a lot of credits entering the market, a lot of fuel entering the market, and a reduced deficit demand. And that's really what's thrown the market into a little bit of an upside down. Is will that trend continue where there's more credits than deficits? I think we're projecting in the short term it will, which is why credit pricing will be, going to remain where it's at, maybe go down a little bit more, maybe stabilize in the $125 range. But it really depends on this quarterly data. So we're going to be looking at that and dissecting that at all levels. And I think Derek, to answer your question about RNG, it's been a really, really interesting push, because the average CI carbon intensity of RNG entering California, or the amount of RNG generating credits, was like positive 45 a few years ago. And then we started to see these low CI, negative 200, negative 300 dairy RNG, swine RNG projects. And more of those have come online, where a few quarters ago, that 45 dropped to positive 35. And then it dropped to positive 3. And then it dropped to like negative 5 the next quarter. And I think the last quarter, again, Paul said we're anxiously looking for the data to be released later this week for the rest of 2021. But we fully expect that the average RNG, CNG used in California will be like negative 60, negative 70. And so really what that shows is, if you have RNG that's higher CI than negative 60, negative 70, it's going to be really, really difficult to get that RNG into the market. It's essentially saturated right now. And so landfill gas, wastewater treatment plant gas, really any positive CI RNG is going to have a hard time finding that placement, because the average CI score has gone so low. That's only going to continue as more and more of these low CI dairy projects. We're estimating about 150 new low CI dairy RNG projects will enter the California market in the next 3 years. We're tracking probably 250 dairy projects. And so that trend will definitely continue. And then the big question is, we can predict that fairly well, because we know what projects are in development or under construction. What we have to look at then is how much renewable diesel actually gets into the market. And if it's significant, if you start seeing an extra 1 billion gallons of renewable diesel getting into the California market, whether that's renewable diesel or sustainable aviation fuel, that's going to be the linchpin in our mind of, will the deficits outpace credits, or will credits outpace deficits? And we expect credits to continue to outpace deficits here for the next couple of years, which is going to keep that pricing pressure a little bit, around what's happening right now. But we do think then, as more states open up, I saw there was a question about more states and what's the pushback, and why aren't there more? Just politically, it takes forever to get these things through. And New Mexico's on its about third year of trying to do something. I think it was a tie vote that it failed this legislative session. Yeah. And then once the state comes online, if you think about Washington passed a couple of years ago, you have to write all the rules, you have to implement it, and then these programs have a really slow ramp up, just like you can see in the California LCFS program. So in our analysis and reporting, if a state gets passed today, it's probably 3 to 5 years before that state has any meaningful impact in the biofuels market, because of how long that ramp up period takes. I think Canada will be a little bit faster because it's such a huge market. But even then, that was supposed to start December of 2022, later this year. We're already seeing that will probably get delayed into 2023, as they still have to formalize the rules and the modeling tools in order to do that. So that's a really long-winded answer, I think, to say, kind of what's happening in LCFS, why our credit pricing is down, and then some of the factors, as Paul mentioned, what would increase prices? Well, it'd be lower fuels. If California all of a sudden says, wow, we're on a great pace, we're going to make our 30% reduction, or our 20% reduction by 2030. So now we're going to make it 30% or 40%. or we're going to go to, a 50% reduction by 2040, something like that would really pop the top back off the LCFS market. And we could see something happening there. But it really is just a function of how many fuels, how many renewable fuels are entering the market, and how much fuel is being consumed, because those deficits really set the overall demand for credits.
That's great, Brad. And maybe I'll touch actually with the next question on where you just ended. So when you think about the credit demand side of the ledger, could you share your initial impressions on the 2022 scoping plan prepared for CARB and its potential impact on the LCFS markets?
Yeah, that's really interesting. And I think that we're something we're tracking very, very closely. And many people, the scoping plan, I don't think we've seen the final draft, what that's exactly going to look like. But I will say that there's a lot of people pushing CARB to increase the rules. They want not just dairy and swine manure from an RNG perspective to generate avoided emissions. They want more CCS projects, not just deep well injection, and full sequestration. They want some innovative technologies. People would really like to see poultry litter and avoided N2O emissions be rewarded under the program. All of these things would increase the credit supply into the California market. And so if it's, we'll see what the draft scoping plan looks like. But in general, the industry is pushing for more inclusivity and better and lower carbon intensity score fuels to be rewarded under the program. And if that happens, that's going to further generate more credits from similar volumes of fuel, and is going to it potentially has an impact on that overall credit supply in the market. But as Paul said, the thing to really look forward to is, will CARB change that goal? Will they do anything? And because of the trajectory of the program, and that's not a bad thing. The program has been super successful. It's done exactly what CARB and the state of California wanted to do. Maybe even a little too successful right now, because they're putting so much renewable fuel into the California LCFS market. Will they change that goal to 2030? Like Paul said, probably at a minimum, they're going to look at extending this beyond 2030 because it has been successful. So we're really looking to see what does that final scoping plan look like here. They're probably a year behind on that. I think they wanted to have all this done and wrapped up and implemented January 2023. That's not going to happen. So it's probably going to be more like a January 2024, maybe even a 2025 implementation for the scoping plan.
Perfect. And then maybe referencing page 15 of your presentation, just wanted to ask for your insight on the broader LCFS markets. In our view, the capital markets are certainly focused or heavily focused on the California market alone, certainly in the Armageddon scenario, with the view that every renewable molecule will be directed towards the state of California in perpetuity. In your view, when will the other states and or provinces begin to indirectly impact the California credit market?
Let me take that one, Derek. I think there's something happening that people aren't noticing, because, and I'm guilty of this as anyone, because I'm an old RIN hand. I'm very, as Brad will tell you, I'm a very pessimistic person. So I've always been like, hey, it has to be a mandated market, or no sane person would invest in a project to feed it, right? And that comes from being more on the refinery side, servicing those folks who are very cautious, very late to enter these markets, but they are in these markets now. The speed of growth in markets, even outside of these mandated markets, is what's going to be the next factor. So I put this graph up of the 3 mandated markets for low carbon fuels that have tradable credits that you see prices listed here. So one might say, if you have a view that mandated markets with miscible programs, very similar programs, are where all the CI fuels are going to go to, that would be missing the huge and rapid undercurrent of things happening in the market today. And I would say for RNG, that's really important. I would say that there's not one RNG project that's coming on right now that isn't considering a voluntary market offtake. Or if there are multiple or trying to diversify their offtakes, with putting one foot in each boat, right? So yes, there's a certain appeal especially to an investor who has a very cautious marching orders to go to mandated markets that are supported by government policies. And that's how things were in the old days, where I was really stomping around, working on due diligence. But on the other hand, the growth of the voluntary markets is happening without governments. It's happening, it's self-organizing. It's being driven by industry. And if there's one thing industry does well, is it just gets things done. So while governments are languishing, and Brad pointed out the timelines on expanding rules in California are drifting out, same thing in Canada, states are taking a long time. The voluntary market's exploded. We've seen RNG move from getting $8, $10, $12 per MMBTU in the voluntary market. I was talking to a fellow who makes biomethanol, and now he can't get it for less than $18, $20 for MMBTU. And he's offering very attractive off-take terms in terms of a nice steady price out 10, 5 years. He's trying to get these, which is super attractive from an investor, particularly a debt investor standpoint, to have a nice flat fee, like the old days in power PPA agreement. I can just back to back this with a loan with interest, and boom, I'm going to make my margin. That's a very attractive thing for a very big portion. He can't get those prices for less than $20. So there's something that's happening out there. I think these graphs that I'm showing you don't show that kind of growth in the voluntary market. And I think it will take over our outlook on low carbon projects. By next year, you'll want to have us back to talk only about those markets. There won't be a government graph. We'll be showing graphs of independent market trades, reported things or announcements by companies are saying, yeah, I bought this gas for $25 per MMBTU out 10 years and I supported 5 projects because I'm XYZ big publicly traded company. I think that's what you're going to see next year. I think that's where investors should keep their ears to the ground. And I think all projects should be out there smelling out opportunities in that market.
Yeah, and I think, Paul, just to build on that with RNG specifically, because you can use it for thermal heat, you can use it for transportation fuel with that book and claim concept, is that voluntary market is that RIN price, that high RIN price has kept that voluntary market price increasing. Because when you're talking about $35, $40 per MMBTU RINs, you don't even, if you're a landfill or a wastewater plant, if you're in California, the clock is ticking. If you're just bringing on a project, you're probably not even getting into that market anyway. So you're relying on a RIN or that voluntary market deal. The thing that we're seeing that's really exploded are utilities that are buying and acquiring and developing RNG assets. So they have a mandate. They see RNG as a way to stay relevant and to bring some solutions, because they're still fossil based. They're 100%, 99% fossil-based fuels in the pipeline. And many of the states are giving utilities the ability to rate-based investments. So they can go develop or acquire RNG, buy an RNG asset, develop an RNG asset, and spread that across all their customers. And that's been significant in order to provide that stability of $17, $18, $20 per MMBTU that Paul mentioned. We don't see that going away, because our short-term, maybe why we're a little bit pessimistic on the LCFS credit price in the short term, we're very optimistic on the RIN price in the short term. We'll see what the RVO, the future RVO numbers, but we were projecting, maybe upper $2, low $3 per MMBTU or per D3 RIN price earlier in the year, and we're sitting at $3.45. So really, really strong D3 RIN price, which keeps that pressure on the voluntary market pricing. And when there's that many people that are entering this voluntary space that want to buy RNG, that's a really, really good thing for people that have RNG to sell.
That's great, guys. And I'll actually tag onto that voluntary market with 2 questions, one from myself and one from the audience. So when you guys look at the potential size of that non-transport market, do you have any view as to how large it is relative to RNG supply today? Number one. And then number 2, when you think about the voluntary market, it's generally the landfill gas that's the favored feedstock. Do you envision a scenario where the utilities and or corporates would pay up for ultra low CI like dairy RNG, which would clearly place a premium on projects that are more beneficial to the environment?
Yeah.
Yeah, I'll just on the last one, because the dairy RNG, is a question. We've been having a lot of conversations with people about dairy RNG. People will say, that stuff's worth 50, 60, 70, 80, $100 per MMBTU for really ultra low dairy CI. And the voluntary market has historically said, I'm not going to pay $40, $50 for something that is the commodity is worth $3. And I'm going to go buy landfill gas and I can get that at $15, $17, $20. But if you look at the carbon intensity and the metric tons of CO2 that you're avoiding, if you're just into it in doing that to get a volume of RNG, you don't care about carbon intensity score, then it makes a ton of sense to buy landfill gas. But we're seeing a shift towards caring and wanting to know what that CI score is. So if you're going to buy landfill gas that maybe has a CI score of positive 40 and you're going to pay $20 per MMBTU, why would you not entertain the idea of paying $40 for negative 250 CI RNG, because you're getting 7x the reduction by doing that? I don't think that story and message has fully made its way through the voluntary market, because people are still, in the mindset that it's a volumetric based deal, but it is shifting into carbon intensity. And so will that shift over, and will people start looking at, will people be selling dairy gas into the voluntary market? I think they will at some point. I don't know if that'll be, this year or next year, but ultimately it will get there, because it makes too much sense from an overall, emissions reduction, GHG emissions reduction standpoint. But go ahead, Paul.
Yeah, Derek, I would just add to what Brad said. The current market is like, oh, we replaced 20% of our natural gas use, petroleum natural gas usage with RNG. It's volumetric. But the entire economy, and I'm going to make a bold statement here, the entire economy is soon going to do carbon accounting on every aspect. So your ESG plan, if you're a company, is going to say, hey, we are this carbon intensive. We measured, the unit of measure will be tons of carbon. How much did we reduce it by? What's our plan to reduce it by? Oh, we're going to buy our RNG. Well, the next question is, well, what's the carbon intensity of that RNG? How many tons of carbon am I going to be able to reduce it towards my ESG plan? There's going to be that valuation that's not understood now. This is a really exciting time, I think, for investors, because a little bit of education puts you ahead of the curve, right? If you can say, I understand this market not as a volumetric market, but as a carbon intensity, tons of carbon market that's about to happen, you can see opportunities there based on CI score and start to differentiate scores that way. Now, there's a lot of education that needs to happen. But it'll happen, trust me, because I was there when we rolled out RINs. I was there when we rolled out LCFS. It happened quickly, and then we've seen the results. So happening on its own in a self-organized way is of course chaotic, because there's no rules that we can all go reference off a government website, but there is a way and a path forward for this to be logical, and that is CI scores. There is accounting. I mean, we're one of the few companies that does carbon accounting. So we know that you can do it with a very logical system, and you can count when someone comes to you and says, hey, the CI score is XYZ, that you can count on that CI score actually being able to generate X number of tons of carbon reduction and have some value soon.
What I'll probably end with is just really pulling this all together as a discussion. Could you share with us your views on the likely trajectory for LCFS pricing and D3 pricing over the next few years, and maybe just offer some perspective around your lower and higher scenarios?
I think Brad talked a little bit about where we're looking at for LCFS, a very low probability of going back up to 200 unless there's policy change. I think when you talk about LCFS, you have to talk about it in terms of scenarios. That's the only, and so if you're an investor, you have to say, I'm betting on the probability of this scenario. And there's some people who come to us, say, hey, we're a carbon-based fund. We see the world this way, and we can assist you as a company putting projections within that match your scenarios. I think Brad's already alluded to the fact that We think we can keep the LCFS fairly well balanced in the near term. There's plenty of renewable diesel projects coming online. I saw some of those questions coming through. There's more than enough renewable diesel projects coming online for the next couple of years, and it does take years for them to come out, to balance the system if those projects want to put those fuels into the marketplace. They certainly have enough motivation to do so. It is a combination of RINs and LCFS that gets renewable diesel out the door into the markets. So there is a little bit push me, pull you, but I can't see the LCFS really rearing its head for a while, especially until we have some policy driven disruption, because the market's smart. They have a schedule in front of them to 2030. They hire guys like me to go around and run scenarios for them all day long. People like us put out generic outlooks on just some of these scenarios and say, hey, this is what the future look like when you run the base scenarios. You could do it easy. I think you'd have to have something disruptive like that policy. You'd have to have a real turnaround in the speed of the mandated markets, or dark horse, somebody starts saying, you know what, I'm converting my entire transportation fleet to renewable diesel outside of California on a voluntary market because I see carbon going to $80 like it is in Europe. So right now, that value at $30, which is what the carbon market's at, $20, I'm making a big investment on that. Then you'd see something disruptive, but I think the base case is pretty flat. And Brad, I think you'd agree there, but and how do we see RINs? Brad, I'll throw that to you because it's the hot potato.
No, I'm with you on LCFS, Paul. I think that's a good way to look at it. And we'll be looking at quarter over quarter data to see that supply versus demand and how that moves forward. I think on the RIN side, the market has been operating without like an official RVO for a couple of years now, and I think it's stabilized itself. It's figured out like how it wants to self-regulate, which I don't think has never really happened under the RFS before. So the things, if it continues with that going forward, I think me personally, I'm pretty optimistic where pricing. I think they'll stay strong. The higher gas prices, as gas prices go up, that cellulosic waiver credit that Paul mentioned goes down, and the D3 RIN price cap goes down a little bit. So we could have some little bit of downward pressure from just from higher gas prices on the D3 RIN side. But absent of any RVO, I think we'll continue to be in that upper $2, low $3 range. The big unknown, as Paul said, is when they put out this, what's 2022 and beyond going to look like. We need to see what those numbers are, and will they do it in a year over year fashion, or what we're hearing is maybe they'll put out multiple years at once, two years or 3 years at once from an RVO perspective, and then have the ability to go back and reassess on a year by year basis. If that happens, we'll probably swing back into how the RFS had operated pre 2017 really. Depending on what those RVO numbers are. But so absent of any new information on what they're going to do, I think I'm optimistic on D3 RIN pricing. It's been strong for almost 2 years now, and we don't even have an RVO, and it's been strong. And so I think that says a lot about the RFS. That would have never happened 5 or 6, 7 years ago.
Oh yeah.
and
Brad, to that point, we've had years where our RVO was delayed and prices cratered. So we have a completely different mindset now. Yeah,
for sure.
That's great. That's great, guys. And certainly being mindful of your time, we'll call it a wrap there. On behalf of Stifel, I want to thank Brad and Paul for their time. And I also want to thank those who have dialed in for our event. Thanks again all for your time.